Well, it's been 2 weeks since the last update. Don't let that stop us. Let's get right to it. First of all, what has changed in the last 2 weeks? Well, the world's catching up to us, all right? Because after Q1 GDP came out and it was revised negative, I started pounding the table on this because it was self-evident. I mean, for what reason should we have expected Q2 GDP to be positive after Q1 was negative in a world where everything's getting worse, not better? It was just common sense. It was an easy call. So back when everybody was saying there was a 25% chance of a recession in like the second half of 2023, nonsense, utter nonsense, right? We were pounding the table on this channel and on Twitter that we were already in the recession. And clearly this is being laid out to bear. So negative 2.1% estimate for Q2 GDP. All right. This is significant, because it puts a healthy level of support underneath it, right? I mean, negative 2.1% is huge, all right? So any upward revision, I mean, it would have to be even more massive to make up for this deficit. So what this really tells you is that the recession is all but locked in, okay? And the reason why this is important is because for all the reasons we started talking about this months ago, this changes the narrative, all right? This changes the playbook. All right, so while everybody else is going to start reacting to this now, we have already prepared for it, right? We're mentally prepared for it. This is not a shock for us, and we're financially prepared for it because we know what happens next, which is to say the Fed has lost its backdrop to hike aggressively. Even though they never hiked aggressively to begin with, that was all narrative also, but again, for the sake of narrative, they can't do it. In fact, they probably can't hike at all. I do think they hike one more time in July at the most, and that's it. So the pivot is essentially here. The playbook has changed. Now, this is not to say that the market doesn't have more downside ahead, all right? But in the case of yields and bond yields, I mean, you can see on the 2-year, it did not like getting over this trend. We got a peekaboo wick, and it's turning around. On the 10, we have come back, and we found pretty strong support, actually. We found strong support on that trend line and on the 200 moving average. And this, by the way, is the monthly chart. These are monthly candles that just closed out at the end of June, okay? So this is a big macro picture of what's going on. Despite how strong the support looks, we're going to keep going. Just stick with me. 30-year, same thing as the 2-year. Peekaboo failed breakout here, all right? And so it's resting comfortably below, all right? So all signs right now point to yields rolling over. In fact, the market is pricing in the Fed capitulating. So not only is the market pricing in the Fed not taking rates as high, they're also pricing in the Fed cutting rates. Again, this is something that we predicted a long time ago. I tried to tell you guys that the Fed could not find inflation, that this was all nonsense, that it was all narrative, that it was all fake news, okay? And that it was all about them trying to save face and get some credibility. It was all a game of chicken with the market. That's all this ever was. That's all it ever was, which is why you, as an investor, needed to understand that when you're holding things that are fundamentally valuable, you have to understand that this is a temporary setback in the market. You need to be accumulating on weakness because it's about to turn around. That's not to say you need to go buy Netflix. That's not to say you need to go buy Tesla or anything else like that, right? None of these zombie companies. But fundamentally bullish things, especially the commodities, you need to be accumulating on weakness because when this turns around, they're never coming back. Let's take a look. Here is the spread on the U.S. 10-year Treasury and the S&P dividend yield. Now, you can see that the yield is way overextended, all right, from what we'll say is the mean of the yield. Okay, so the 10-year here, this chart is clearly showing that the 10-year needs to come down quite a bit. So despite the strength that we saw over here, right, we have charts like this one telling us that the 10-year really needs to come down, all right? This is backed even further by charts like this. So this is the gold-copper ratio, all right? And you can clearly see that the 10-year tracks the gold copper ratio. All right, it follows it. The gold copper ratio is the leader here. And once again, the 10-year is way overextended and it needs to come down. You put this on the backdrop of a recession is here, right? Predictable, easy, with the Fed no longer having the ammunition to raise rates, okay, and are likely to pivot, okay, which would return a bull market to the bond market, okay, and then you can see why this is probably going to catch back down. All right, so you have a confluence of the fundamentals of reality taking place, all right, with the historical analogs here in the charts. So all of this is pointing to the same thing. And so it's easy to draw a conclusion of where we're going. This is not complicated. And so you should not be overthinking this. But what about quantitative tightening? They're going to raise rate, blah, blah, blah. Look, man, I'm telling you right now, risk is on the x-axis, all right? So in the case of bonds, if anything, your risk is on the long end. This is where you might see rising yields, all right? Because 30 years out from now in today's market is truly unknown. But in the next couple of years, even decade, you know where we're going. And it's more easing and it's more printing. It's just that simple. That's what they're going to do. And so there's no reason to overthink this when the smart money already knows what's going to happen. All right? So how do you play it? So first of all, you have to understand that this is not a problem unique to the United States or even the Federal Reserve. This is a global problem, especially among the Western nations with synchronistic and conforming central banks. I mean, all of these banks play the same playbook. They're all on the same team. They all act independent, but really these guys are all in the same club, okay? They're just vassals of the American empire, and they all follow direction, and they all play in unison with each other to keep the status quo going. More evidence to this was the way they all responded to the pandemic, right? In fact, you listen to people like Lagarde talk about their response to the pandemic, and that tells you all you need to know about how they're going to respond to this. Right? They don't want the system to collapse while they're in control. They understand that there are nationalist movements rising up. You have to understand how much of this is political. Okay, and the tides are turning. Okay, there are paradigm shifts taking place among the populace globally. Okay, people are becoming more independent. People are becoming more nationalistic. And people are kind of fading the concepts of globalism for better or worse. This is just a reality of what's happening. Okay, and so you juxtapose this with the central banks being stuck in this position where they have to fight inflation by raising interest rates and tightening, while the country that they serve has sovereign debt crisis. Right, that's unwinding. Right, so you have the United States running 125% debt to GDP. Right, and this is true for all of these Western nations. This is true for Europe. This is true for Spain and Germany and Australia. I mean, all these countries are just maxed out the credit cards, okay? And so there's a mathematical ceiling on what they can do with interest rates without causing default for these sovereigns, all right? And this is important. This is why all this, these central banks fighting inflation, it's a bunch of nonsense, and I tried to tell you that. So, yeah, we've come this far, but it's all just been narrative because they can't go much further. And in fact, we're already at the point where they're starting to roll over and the market's pricing it in because the markets know it. Okay. So this was easy to forecast. This was easy to see coming. Okay. So what happens next? Well, I can tell you what happens next. Just look at what the politicians are already saying.
Inflation is like an illness, and the medicine needs to be tailored to the specific problem. Otherwise, you could make things a lot worse. And right now, the Fed has no control over the main drivers of rising prices, but the Fed can slow demand by getting a lot of people fired and making families poorer. So I just want to say, you know what's worse than high inflation and low unemployment? It's high inflation and a recession with millions of people out of work. And I hope you'll reconsider that as you drive this, before you drive this economy off a cliff.
So you see, there you go. Even the dumbest people in the room understand what's going on and what's coming next, which, by the way, is a testament that these people aren't as stupid as we try to give them credit for. Okay, I think it's a mistake to keep calling all these politicians stupid because you're giving them an excuse You're giving them a way out of the things that they do, right? Why should they be held accountable if they don't even know what they're doing because they're too stupid to understand the consequences of their decisions? No, these people do understand, all right? And you got to stop taking that excuse away from them so that they can be held accountable for the decisions they make. And so again, look at this chart. This is the debt to GDP for the United States. Listen, it's too high. There's nothing that can be done about this. It's locked in. I mean, yeah, there is something you can do about it. You can reduce spending. You can cut entitlements. You can take away all the things that a lot of people rely on. You can be the party that loses all the votes for taking freebies away, okay? And consequently, you can also raise taxes as the country suffers from inflation. So you can totally kill the economy that way too. So do you understand that that's not going to happen? It's not going to happen. And getting the interest rates high enough to stop inflation is not going to happen either. So it stands to reason that the only way out is the same way we have always taken out as a human civilization who have been in this situation in empires past, which is to inflate the debt away. That's what we have always done. That is the Occam's razor solution to this problem too. And so although there is nuance and there are different paths we might take before that day actually comes, that is the inevitability. I mean, you have to understand that if they choose default, if they choose massive deflation to the point of depression, that will be a conscious decision to do that, okay? Because if this idiot with the microphone understands that as a consequence, they understand that as a consequence, okay? This is a conscious decision. And if they take that decision, that approach to the problem, which, by the way, is probably the long-term correct solution, even though that's the most painful, to go through a depression and to deflate and to kind of reset the entire system and to account for all this debt and these interest rates. Yes, that's probably the right solution, but it's also the most painful. The idea that politicians and bureaucrats are going to get behind this to get it done is extraordinarily silly because they'll have to face you, an angry populace, after making that decision. After you lose your home and your job and all of your savings, and there are no entitlements or no government handouts to help you get through it because everything is completely collapsed, how are they going to build back better, right? If you're pissed off at them, it just doesn't make any sense. Doesn't make any sense. It doesn't pass the test. It just makes too much sense that they kick the can down the road and that we are getting closer to that than we are further away. And this has implications not only on the life you're going to live, but also the way you need to prepare and the kind of investments we need to make for this anticipated outcomes. So I thought of an analogy to help you guys kind of visualize and understand what's going on with our economy using the analogy of a heartbeat. All right. And so this random image that I found on Google, we will say, is to scale. Okay. So the body is the United States of America, and this enormous heart is a to-scale representation of our economy, okay? The economy is the heart, all right? And every time it beats out the life force throughout the body, all right? So just like the heart in your body or any other heart, it has physical limitations. So maybe if the heart is underutilized, it'll have a very hard time performing if it's asked to perform a task, even some light work or, light jogging, going up a flight of stairs. It might just run out of breath, right? It just can't handle it because it's underutilized, right? But a very strong, lean heart can run really hard for a long time without having to take a break, right? But just like any heart, it has high-end limits too. So even the most fit heart in the world can't run forever. It has to stop and take a break. Well, the problem is that this heart is so big in proportion to the body because it has been inflated over time. And this is a problem for two reasons. So reason number one is because the heart is so big that should it ever stop beating, it would be physically impossible to resuscitate it. All right. You have to understand, due to the enormity of the heart, there's no way to apply the physical force to this thing. Okay. You could take every defibrillator on the entire planet, zap it at the same time, and it would barely flinch because the heart is simply too big. It is quite literally too big to fail. Let it slow down too much, it stops beating, and it dies. On the other hand, It's been a very strong heart, and it's been running hard for a long time because it's been otherwise healthy, we'll say. Well, the problem now is that the body is sweating profusely, all right? And it's becoming overheated. And the body is having trouble carrying the weight of current prices, all right? And so it's beginning to weaken, and it needs the heart to slow down. The problem is that if the heart slows down, well, it might stop. And if it stops, there's no chance of bringing it back. However, the heart could pump harder. It could pump even harder than it is and give the body the extra force that it needs to pick itself up and get the strength to carry that weight. It could do that. But if it does that, it runs the risk of having a heart attack, you see. So it doesn't really matter what the heart does. Either way it goes, it's at serious risk of failing, you see. And this is the problem with the economy, whether you go slow down or speed up, the heart is in big, big trouble. So look, how is this going to affect the markets? What do you need to know? Well, I don't think a lot has changed in terms of the bear market rally. This was still an excellent candidate for a rally in terms of the horizontal support here at 3,600. You got the bounce on the 200 on the weekly, which corresponds to the real close to the 50 on the monthly. Okay, so there's a lot of confluence there. Okay, and if you want to try to measure the upside, we can go back to the weekly and say, all right, that should be at least be a goal right there. It's the 50 again. That's about 42.36. Okay, if you switch to the daily, 42.36 is right about the 200 on the daily. So again, you can see confluence there, and it kind of makes sense because if you were to break the 50 on the daily, you're probably going to have a hard time getting above that 200, all right? And so I can see this 4,200 level being a bit of a max upside for the rally. And again, if you go back to the daily, or excuse me, the weekly, come down here and look at the RSI. So you had a low and a lower low with a double bottom on RSI. So this was a clear buy signal here. This is a reversal sign, and we have started that rally, and it just makes sense that we could get up here. Now, this is probably short term. I think we need to come down to at least 3,400. I know a lot of people are forecasting lower levels than that, and that could happen. But we need to at least get to 3,400 first, right? And then we can start looking at things beyond that. But it is true that we have a lot of bad news kind of baked into the cake in terms of earnings. I mean, if you think about what happened to companies like Walmart, remember when they got those bad earnings? Well, you still have earnings like this baked into the cake, thanks to, at least if nothing, to the bullwhip effect. So you remember all these supply chain issues we had, and you've been waiting for months or years for appliances and furniture and all kinds of things you wanted, right? Well, because of the bullwhip effect, you're about to have too much of this stuff. Okay, so where Walmart once suffered for eating the inflation and not passing it all onto you, and you still dealing with some inflation and not buying other things that you used to, well, now Walmart and other retailers are likely going to have so much excess inventory of key items that they're going to sell them at break even, if not a loss. And this is going to hurt earnings again. So baked into the cake is more downside, and so that's okay. However, baked into the cake is also upside. A lot of people really underestimate oil. Oil is in a bull market, you understand? And it's not going to stop anytime soon. OPEC keeps promising more production and they can't keep up. If you saw that video recently with Trudeau and Biden, Macron had to go out of his way to let Biden know that OPEC can't increase output, at least not for another 6 months. And even then, it's not going to be much, all right? We've talked about this on this channel before. The energy crisis is real, all right? And so you got to wrap your head around that and understand oil has earnings coming up too. And you've got companies like EOG and Occidental and all these great companies who are likely to beat. And what happens to those companies when they get good earnings? I think it's likely going to be a catalyst for the next leg up in oil companies, oil equities, right? Because I understand why people are afraid to buy oil up here. It's because it's scary, right? I mean, if you just look at the history of oil, when it has big run-ups, it collapses, okay? Because it's a signal of a lot of things, right? And people have a hard time paying for expensive energy, right? And it usually precedes recession. And so getting up here is a very scary place to be for oil. You have an historical high risk of it selling off on you, right? It kind of tops out and goes back down. And we already know we're in a recession right now anyway. The problem is that this time is different, and these high oil prices could persist for a long time, longer than people are willing to appreciate. And so, this energy crisis is very real. And in fact, they're probably going to use this as the backdrop for all the money printing that they want to do. They're going to say that they have to save the climate and get off all this expensive oil, right? And this is going to be their narrative to start printing all this money. It's not like they're going to admit that they have to print all this money because they screwed up. No, they're going to make an excuse. And the excuse is going to be the climate because they got to save the world and oil's too expensive because these big fat cat oil companies, all they know how to do is just get filthy rich on polluting and destroying the world. Right? And you can see this coming a mile away. I'm just telling you, it's just easy peasy. But, as far as the broad markets may fall, I think something else that goes underappreciated is how much of a rotation that there's likely to come, because you can't print oil, all right? And if you just like we talked about the heartbeat economy, right? You let this thing fall too much, you'll never get it started again. So all of this underinvestment in oil, you let the system collapse, you go into a deflationary depression, and that underinvestment just goes down to zero. And how are you supposed to get out of that hole? All the cheap, readily available oil is gone, okay? And we're spending all of our excess reserves. And so this crisis is not going away. It's going to last for a long time. And what you can anticipate most likely to happen is what's happened in the past. And so in the last inflationary environment, like the 70s and early 80s, by the time it was over, energy accounted for close to 30% of the S&P. All right, and we're only at 5% right now. So there is a lot of rotation to come, all right, with bad money rotating into good. All right, and there are more and more talks about this Bretton Woods 3 and fiat currencies being backed by a basket of commodities. All right, listen, it is still early in this commodities game. And a lot of people are trying to call the top on it. I just don't think they understand what they're talking about. All right. They don't understand what's next. All right. I mean, these people are not going to suffer your wrath of the depression. All right. Senators would swing from lampposts. And that's exactly why they're going to print all this money and they're going to save the planet. And all these commodities are just going to take off and they're never going to come back, which is exactly why I'm accumulating. But beyond that, this is part of why I think some of the broad indices might not fall as much as people expect, because money is not all just going to sit under some couch cushion, right? It's going to rotate. There's always a bull market. And I think energy is clearly it, and it has a long way to go. And specifically, we're talking about oil here, but I think uranium is close to follow. And by the way, I've talked about this a lot before. If you're new to this channel, I have had a lot of success trading crypto in my life. And I've done it on macro moves, just a couple of clicks. I mean, you don't need to be getting in and out of crypto. That implies you don't understand it. Crypto largely follows the Fed balance sheet. And when they're contracting, you have to get out. Right? In fact, it double topped and started to roll over on this head and shoulders with a bear flag. I mean, every technical indicator in the universe that you needed to get out, with the confluence of the rumors that the Fed was going to start tightening. And that's not a coincidence, all right? But likewise, once they announce that they're going to start easing again, I think that crypto is likely to have another leg up, and I will probably buy some. And I will ride it until that paradigm changes. But until then, there is absolutely no reason to touch it. You don't even need to look at the chart. But I will say that Bitcoin is somewhat of a leading indicator for the broad markets these days. I do think it is important to watch it. Because you can see how much downside it has left just to at least catch this trend line, which has confluence here about this $14,000 level. You have support around 12 and then 10. So I think we're going to have to hit at least one of these levels. It doesn't look like it's going to hold up too well here. And that's okay. Just let it keep selling off and let people get liquidated and let all the bad money get out of there and the over-leveraged people and just let it clean itself out. I don't believe in this stuff. I don't want to get caught holding the bag on it, but I will absolutely own some once the narrative changes and the Fed begins easing. Okay, let's kick it off with Cameco. I am loving what I'm seeing here. Everything is on point. Nothing has changed. Congratulations to everyone who's been accumulating in what is clearly a bull market. I mean, you have had a sell-off in what is clearly a bull market. And it's just so obvious to me. And it's unfortunate that so many people are getting scared and shaken out here at these really strong levels of accumulation, which is exactly what it is. Do you remember when I first told you, when we first started selling off, I said, well, what's next? I said, well, what always comes after Wyckoff distribution is what? Accumulation. And I told you to be accumulating all along this thing, didn't I? Go back and watch the videos. I told you, and this is exactly what's happening. All right. And it's clear that we are in an uptrend, and the RSI is confirming that the uptrend is going to remain intact. Because look at it. First of all, you got to understand something. Look at the bottom side of the price trend, okay? Which in this case is this line right here. You're setting low, higher low, higher low, higher low, higher low, okay? As the RSI sets lower, lower, lower low, all right? So this is called a hidden bullish divergence. It's a continuation pattern. What it's telling you is that despite the sell-off, just like this sell-off and just like this sell-off, you're going to continue the trend, which is bullish, because uranium is still in a bull trend. At least Cameco is, UEC is, NXE is, right? And these are the names you need to watch and pay attention to, right? Because these are the sector leaders. That's why we watch the big names. We've already realized this, right? We've already figured it out. And that's why I told you, I don't care what the price does. I do not care unless this level here is broken on either of them. I don't care. All right. So as long as you're setting higher highs, it's all good. Okay. So unfortunately, a lot of people have gotten shaken out, but the trend is pretty clear, and the trend is your friend until it's broken. If price breaks this trend, then I'll say, okay, the trend is broken. It's not a bull market anymore. But until that happens, it clearly is, and that's just non-negotiable, okay? And the RSI is telling you that you should expect the trend to continue, all right? And it's really on all time frames. I mean, look at this. Look at this. So you're setting, look at this. You got a double bottom right here, okay, on ascending RSI. That is bullish, okay? You should expect a rebound here. Now, in the short term, we have a little mini double bottom within a larger double bottom, okay? And you want to break this level here, about 2350, all right? If you can't get above that level, if we come up here and start turning around, and this is, look, this is going to be a lot of resistance, I'm not going to lie. You have the confluence of two moving averages, okay? And this level right here, which is obviously tricky. If you can't beat it, then I may change my mind because we may roll over here, okay? But for now, you need to be buying in anticipation of this breaking because it looks good until it doesn't, all right? So if you're looking to get out, you at least need to hold on until you get back to this 2350 level, and then you can see whatever your related equity that you care about, how it's performing. But remember, Cameco and USC are going to be your guides, and your first target is 2350. Can we break it, all right? And if we do, the next target is here at the top of this W pattern, all right, which is about 28 bucks, all right? And again, same thing. If we fail here and turn around, we sell, okay, because it's going to come all the way back down again, all right? But if it breaks, then buckle up because it's got a long way to go for this measured move, all right? It's going to come to the top of the trend just like it always has in the past. That's what it's going to do. And so there's no reason to jump to conclusions. The trend is your friend until the trend is broken. All right, so let's just let the market tell us what it wants to do next. And right now, I think you have descending volume over time through what really is a consolidation phase. And I'm really looking for a major spike in volume to provide directional support. Hopefully it is to the upside. But if it's not, I think we'll get signals before that happens. And it's very possible that there will be quote-unquote news in the near future that will act as a catalyst to take this to the upside. But clearly, you're seeing accumulation here. There's a lot of support along this trend. It is clearly in an uptrend, and the trend is your friend until it is broken. I just don't think it could get any more clear than that. Same thing here. Look, you have a double bottom, ascending RSI. It's just not hard. It's not hard. So this is a buy signal. Okay, you're likely to see some upside. I think we at least retest this 374 again. This is going to be important to get through. And then once you do, we test 475. All right. So just hang tight. I'm liking what I see. Nothing has changed. The strategy is the same. And let's ride this thing out. I did change the way I'm charting NXE. I think it was incorrect to have it in an ascending channel. This is clearly the way it needs to be charted here. It is in a sideways consolidation pattern, much like Global Atomic. And so this is your support level down here. Also a double bottom on ascending RSI. It's telling you the same story. Zoom out on the weekly. Look at this. So you have a clear test of this bottom. All right. So the price is really going sideways on the bottom while the RSI is cooling on the bottom. This is another bullish signal that the trend is going to continue. All right. And even if you break, look at how close the 200 is just below you. That's why I'm saying, even if there's a break, I think it'll be so short-lived that you won't even care about it, right? You might not even catch it to buy it, right? I don't think there's any risk on the x-axis, which is to say time. I just don't see it. All indications say that this trend is going to remain intact. And unless that changes, then we're going to play it and profit. So silver absolutely shat the bed, and I couldn't be more pumped about it, honestly, because not only did the physical price roll over like a dog, but the equities rallied. Okay, and that's all you need to know. That is all you need to know. They held that double bottom like studs. Some of the weaker names slipped through, but we've been through this story before. We've talked about it too many times, right? That's why we watch the big names. Everything that broke through, that's a buy, man. That's a value. And let me tell you, I'm eating it up. So to all the people who were calling for this breakdown, good job. It looks like you're going to get your price targeted right there about 19 bucks. We'll go ahead and put it on the chart to evaluate it in the future. But either way, whether the physical gets there or not, clearly the market thinks that this is oversold because they're running into the equities. Even as silver was down 4%, a lot of the silver miners were up 4%. So super, super, super bullish sign. I'm really liking what I'm seeing. And, this is a weekly chart of the physical silver price here. And look, this is where the RSI is right now, about 33. And there are very, very few times throughout silver's history when the RSI is lower than it is right now. Okay, so anywhere between now and lower is an excellent opportunity to get in. I am very happy with what I've seen. You had the strong rally here. Pretty much everything has this nice wick. Even though you set this lower low, you had the double bottom on RSI. You see that across the board. That is a bullish signal. That is a signal of reversal. Okay, and listen, I am so stoked about silver right now. I was actually home on Friday, and I got to play with the markets a little bit. And I almost don't have any cash left because when I saw what was happening to silver, it was too good to pass up. I mean, this could not look better. I am pumped about it, and I don't think that you should have any worry whatsoever about getting in here. Look at the nice double bottom here. Double bottom on AEM, vindicated with the support of the RSI. This is a weekly time frame, okay? Lower low on the price. Higher high on RSI. It's showing you the strength. It's showing you a trend reversal here. Okay, so you should anticipate the bounce, the reversal on this double bottom. And so it looks like we're going to get this right after all. I mean, it still has to play out. We still obviously have to get up here and see what happens. But look, I'm totally pumped about everything that's happened so far. I'm really stoked about it. And I think things are going our way. I think this is one more testament, one more piece of evidence of why you should have confidence, right? Have confidence in the playbook and what the market's telling you. You got to fade all the noise. You have to invest in the narrative. And you can trade, you have to invest in the fundamentals, right? You can trade the narrative, but you must invest in fundamentals. And when the market gives you as much confluence as it's given us, it is just borderline criminal not to play it, okay? So, I'm just loving what I'm seeing. Again, double bottom on RSI with a slightly slanted double bottom here on the price. I mean, that's exactly the kind of stuff you're looking for. It tells us that we were likely going to be vindicated on the call. I actually even got a small position in JNUG. Let's open that and see what it did. So I saw the double bottom here and bought it. And so far, so good. We'll see how it works out. I held on to it, and so I haven't sold it yet. You know, you should really play this only one day at a time, right? You should buy at the end of the day and then see what happens the next day. But I've held on to it, so I'm going to hold on to it next week. I suspect I could get a rally up at least this high. And so we'll be watching that one too. And look, I just think that everything's going the way it needs to go for the gold and silver space. There's really no reason to go down every single one of these, but I can tell you right now that some of these low market cap developers that are just debt free, oh man, and they're flush with cash. We're talking about, you know, $200 million market caps. They have $80 million of cash and they're debt free and they're developing, I mean, on just bajillions of ounces. I mean, these guys, you don't even understand. There's so much value out there right now. And you just look at the big names, okay? Let's just look at a name like AG. Down here in the doldrums, like halfway through with the you know, March 2020 sell-off. I mean, that's crazy. No reason to be down here, and yet the market's giving it to you. Okay, so you want an instance where you can be Rick Rule, you know, buying a, you know, Paladin at a penny. You know, AG may not be a penny yet, right? But it's effectively on the way in terms of value, okay? It has no reason being down here. None of these companies do. These are excellent opportunities to get in. And look, just chill out and have confidence. I mean, look at this RSI divergence. Look at this. The market's telling you that this double bottom is going to play out. We're going to get the bounce. It's just a question of what we do when we get to the top of that W. And, of course, we'll evaluate it from there. But I just hope you can see I just hope you guys are picking up on something. The confidence to make your play and to hold through it and just let the market do its thing, not to get shaken out, you know, and play the fundamentals. I mean, this stuff is not that hard. And I know it can look scary sometimes, but it's just noise, you know. If you're having trouble being scared with the market and your brokerage account sometimes, then maybe don't look at it so much or don't invest as much, okay? That's really all that I can say. But, you know, as long as you understand the fundamentals and what the difference is between the narrative and you look at the price on the charts, right? Use charts, use technical analysis, and find the confluence in the markets between the sectors and the equities themselves. I mean, you could totally play this and navigate this market. And so I hope this is a testament that you can do it. And I realize this still has to play out, but it all looks good, okay? So if anything changes, if this turns around on us or something bad happens, we'll reevaluate. But right now, everything looks good to me. I think you should hang tight. By the way, you can anecdotally kind of find little clues like this that the broad markets are likely going to start a bear market rally. When you look at something like AMD that has not only the confluence of this support, but also it's 200. You look at the RSI, it double bottomed, right? So the low set a lower low, but the RSI did not set a lower low. It's showing strength. Okay, so a lot of people are looking at this like it's in really bad shape, but it's actually kind of due for a bounce. And I think that you're kind of seeing this in the markets broadly. And we'll see if it plays out, but the markets are so oversold, and I think people are getting really tired of the downturn. Even if the downturn is warranted, even though it may need to go further than it is, people are kind of sick of it. And, you know, people start spending money, and this is how, you know, bear market rallies happen. It's just a psychological thing, and there's nothing wrong with it. I think that we should anticipate one here. I think we'll get the confluence of the broad bear market rally with our W patterns playing out in our commodities, and I think that's kind of how we're playing it. And you can really see this playing out everywhere. I think it's good. You know, I mean, come on, man. I just see it all over the place. Everything's super oversold. And I think we're about to get some relief, and we stand to make a profit from it either way, whether we hold on with longs or we reevaluate the situation on the bounce and decide we need to let go of it. But either way, I think we're in good shape here. So what is the 2-minute or less summary of this video? Well, I would tell you this. The markets are extremely oversold. and the markets have a lot of trouble ahead of them. A lot of it's starting to be priced in. I mean, a lot of forward guidance has been slashed down, but certainly we have more bad earnings coming. But on the other side of that, we have a lot of good earnings coming, right? With oil and gas, there are a lot of very profitable bull markets happening right now. There's always a bull market. And what I would say to you is that if you're investing in the same commodities that I am, then you should be buying with confidence and strong support levels, and you should be fading the noise and understand that the Federal Reserve cannot stop inflation. Inflation is here to stay, and you just need to deal with it. And once you accept this, once you understand that everything you're hearing is a bunch of nonsense designed to manipulate you psychologically, then you can really deal with this market from a more mature, educated perspective. And once we do that, we can really navigate it really well and just play things based on fundamentals and technicals and make a lot of money. It's not that hard. And so you may be down in the red right now. You may have bought too early, but that's okay. I would say just hang tight. If anything, it's too late to sell. Okay, you've missed that opportunity. You just need to hang on. If anything, you need to be buying more, all right, especially in the things we talk about. And just hang tight. Understand that the Fed is likely to pivot. We are going into a recession. We called it early. We've been ahead of the markets months in advance, pretty much every single turn, and we are nailing this thing. And I think we will be vindicated again in the long term. I think you just need to hold tight with confidence. And I hope you can leave some comments down below what you think of everything so far and what your opinions are. And let's get some dialogue going. But for all you uranium fans, show up to the uranium Twitter space this Sunday at 7 o'clock. And maybe we can all talk. And it's a great place. Those spaces are really great. And there's a lot of good people in there, have a lot of information to offer and to help you grow. And so I encourage everybody to step into them. If anybody knows of one that's in the precious metals, let me know down in the comments below, because I would love to join one of those too. Thanks, guys.